Welcome to the Retail Hack Podcast. My name is Darius Vasefi, and today I am speaking with Smriti Jayaraman, a principal at Corazon Ventures. Hi, Smriti.
Hi, Darius. Very nice to be here.
Likewise, thank you for being on the podcast. Let's start with a brief bio on yourself and the company.
Sure. So I'm with Corazon Capital. As you mentioned, we're an early stage venture firm. We've been around for about 10 years. Most notably, sort of the origin story affects a lot of what we do, which is one of our founding partners is a serial entrepreneur, with most of his experience in sort of the consumer internet space and a little bit in the sort of commerce enablement space. And that's shaped, what we do today, which is that, we support early stage founders with kind of a very high touch kind of operator mindset type approach, roll our sleeves up, really like to partner closely with founders and tend to focus most of our investments in and around kind of what I call sort of technology affecting the human experience, which is to say, it's not just consumer, but it's kind of everything that touches the consumer value chain. So, consumer tech, everything from fintech to ed tech, wellness tech, social, and beyond. Commerce enablement, both front end and back end. So we'll look at supply chain and logistics technologies, as well as sort of like marketing, customer acquisition, loyalty, marketplaces, both B2B and B2C. We kind of have a business model affinity there just based on prior experience. And then obviously looking at kind of all the emerging technologies touching all of those areas, not the least of which includes obviously AI today. And we tend to focus on sort of pre-seed, seed, Series A investments. We also have a small opportunity vehicle, but really our focus is kind of on the earliest stages. And our team is split between Chicago and LA. We talked, I think, a little bit before we kicked off the recording about geography. So I'll just speak to that for a second, which is, our team kind of comes from all over the country. We've spent time on the coasts. We've spent time, I'm here now based in Chicago at the moment. And our philosophy, I think, is a little bit unique in the venture capital space, in that, we want access to all of the most important innovation ecosystems where the talent is, where the new ideas are sort of brewing. But we also believe sort of the concept of being myopic to one market, tends to drive sort of, just a type of decision making, which, doesn't allow you to one kind of cross-pollinate ideas between markets. You are sometimes chasing the same deals as other investors in that market. And we feel like there is a benefit, at least in what we do, which is sort of sector-focused investing, to having our hands in a few different places. And so we, by virtue of kind of the profiles around the table, like I said, where we've spent time, gone to schools, had jobs, grown up, we have access to, a lot of the best deals in our sectors on the coasts. But we also, by virtue of being headquartered in Chicago, can look at things here. We also spend time looking at deals in Austin, Miami, Denver, and that's benefited us to date. Like I said, our team is kind of split between Chicago, LA, and now SF as well, and we think it's kind of a unique strategy. And I think the last thing I'll say is, we are super excited about. We've been around only 10 years, which is sort of a medium to short history in the venture world. A lot more to go do, but we're super excited. We've got a number of amazing founders in the portfolio. And really think now is a very unique moment to have kind of the consumer focus we do. We're thoughtful about making sure we're balancing direct to consumer with a lot of B2B deals or B2B2C sort of go-to-market motions to diversify business model. But at the end of the day, I mean, the American consumer drives so much of kind of, economic progress in the country and the world. And, understanding that consumer, what they want, how they think, how they make decisions, how they, their priorities shape their behaviors is both such an important and I think fun way to think about how technology is going to shape the future. So that's what we do. And I'll just round out with my background. I've been an early stage investor for the last 8.5 years after starting my career in management consulting, where I also kind of spent a lot of time in technology and commerce, both as a sort of strategy investor and doing some work in private equity as well.
Fantastic. Yeah, I was thinking about when you said the firm started 10 years ago and thinking 10 years ago in 2015, how the world was so much simpler.
I don't think we thought that at the time, right? I mean, it's
Yeah,
like the quote is like, you don't know you're in the good old days when you're in them. But I agree with you. Now looking back, yeah, it did feel like a much simpler time.
yeah. So, I mean, all around. So, what is the how many funds does Corazon manage?
We have basically two institutional funds to date. We maybe a little bit on the firm history. So we launched kind of 2014 was when we ran essentially sort of like a friends and family fund almost accidentally. And then that did well enough for us to raise our first institutional fund in 2017, our second institutional fund in 2022, and we're kicking off a new fund that will go to market kind of end of this year, beginning of next year. And so, sort of somewhere between institutional fund two and institutional fund three, but overall fund three and fund four.
Okay, but you are investing out of Fund 2 right now?
Correct. Our institutional second fund, our 2022 fund, correct.
Okay.
Yep.
And how many investments a year does the company typically do, and then yourself?
Yeah, great question. We don't force a pace on ourselves. We really try to follow the market, and if we're seeing great things, then we'll write a bunch of checks, and if we're not, we won't. But on average, we do call it 10-ish new deals a year, and then a handful of follow-ons. And my involvement in those deals are probably involved in a bunch of them, but in terms of leading investments, it can be three to four, roughly a year.
Okay.
Yeah.
So the point about early stage is kind of like blurry right now.
Yeah.
It used to be early stage was seed, now it's pre-seed and maybe pre-seed. And so what does pre early stage mean for you?
Yeah, I think that, the labels have gotten muddied for sure, and probably with good reason. At the end of the day, I'm not sure the labels matter so much as the dynamics of the round. We nothing is too early for us. So I'll start there in terms of, how early we will go, pre-product, pre-revenue, just an idea. That's totally fine if the idea makes sense to us. We are in the business of investing in founders who can build real businesses. And we will, leverage our experience in these spaces, really thinking about, the viability of a business, the potential unit economics, the potential growth path, the real available TAM. But all that, once we've thought through all of that, there is nothing that is too early. And then, we think about we'll invest through sort of Series A out of our core fund, but generally we'll keep our investments to sort of 50 million valuation and under in the core fund. And the thought process there is, you know, we spend a lot of time with our portfolio. Our approach is very sort of like operator mindset, very high touch. And so to do that, we need substantial ownership in these businesses. And we're also, we're a small and mighty team, and so we can't write a ton of checks. And so it really, we really pushed ourselves to think about what valuation can we get in at where we get substantial ownership, and we can also really, expect a healthy 15 to 20x on that investment. That's what we're promising our investors, and what we believe we can deliver on. And so that tends to be our sweet spot. Now we have, like I said, a small opportunity fund that we will write some later stage checks out of. We may, raise other vehicles in the future, but that we believe is sort of, a very focused and thoughtful seed and Series A strategy.
Let's get into the first topic on, of course, every founder's mind right now is that it's hard to raise money. Of course, it should be kind of hard. It shouldn't be too easy. And then, what's the vibe right now? What do you see, especially for e-commerce,
Mhm.
direct to consumer, retail tech, marketplace, all of these like consumer. So there's like consumer facing and also back
Yep.
end that
Yep.
feeds into consumer facing.
Yes. I think we're seeing a couple things. One is that, even investors who have spent, their entire histories focused on these spaces, there is a kind of a new paradigm of nervousness, of reticence, of hesitation. And that's primarily because we are watching how AI is affecting these spaces real time, and trying to figure out what that means for the type of business model that has defensibility, the type of business model that can really go take like a fair amount of market share, and the type of business model, frankly, that can be a tech company, right? Which has always been sometimes a question in some of these consumer and consumer adjacent spaces. Um, and that is happening in kind of consumer and e-commerce alongside just the general market sentiment, which is there's political fluctuations and there's economic fluctuations and there's potential recessionary whispers, and so it is a tough space, I think, for consumer and e-commerce founders to be in, because you've got this kind of double whammy of like the overall market landscape and then kind of this space that is even for investors who know these spaces really well, is like going through a moment. But we always say, I mean, I always say, I won't speak for my whole team, but I think these types of inflection points can also be huge opportunities for founders and investors. And the opportunity is that when everyone is kind of like waiting and watching and being nervous, those who are ready to invest and the founders that are ready to kind of think about capitalizing on those moments can actually, get an advantage. And I think to double click on that a little bit, within the e-commerce tech stack, for example, we've looked at a lot of very interesting things, right? Whether it's look, we don't need to have the best model or our algorithm needs to be best performing. But if we can use AI creatively, AI that is now cheaper, faster, better, more user-friendly, to create, more top of funnel experiences, right? Gamifying customer acquisition so we don't have to compete on customer acquisition dollar with everybody else. Or think about, conversion in a different way, or think about automating SEO or automating, the content that I put out there. There's just so many tools that now even founders without a ton of cash on the balance sheet can go leverage, to really kind of like improve their operations and do so very nimbly without hiring huge teams. I think some of those founders are the ones that are able to go to market and maybe raise a little more quickly and efficiently, because they've sort of established that they can use AI to their advantage and to create a huge cost structure benefit to what they can do. In a world where there's still a bunch of open questions around, all right, how crowded is this space going to be? Or, if you're a retail tech company that's serving D2C brands, for example, right? Some brands are growing, some of them are not growing as fast, but guess what? They're growing with 2 people instead of 200 people, right? And so there's a ton of opportunity, but there are open questions that you can't answer. What can you go answer as a founder? You can go rethink, how do I make the most of this moment in time and the technology that's available to me very cost efficiently, to do more with less. And then, I've addressed some of those risks so that the remaining risks aren't that scary for my investors to sort of confront. I think the other thing, to step away from like business model and leveraging technology in this AI landscape, that I've always believed, but I think founders don't like to hear, or some founders don't like to hear, but I think we're seeing it go a long way in this environment, is just relationship building. We encourage every founder in our portfolio to have a kind of ongoing dialogue with their top 5 to 7 investors for the next round. And what that allows, kind of stating the obvious, I guess what that allows everyone to do is to get under the hood with a longer time horizon, to understand the risks and the upside, and not sort of be in the position which it used to be. You could be like, all right, I'm starting a fundraising process. I've got 50 investors, and then I have 25 first meetings, and then I have 10 second meetings, and then I have 3 term sheets, right? A lot of investors are like, I don't know if I can learn enough about you in 4 weeks to make a decision. The things I'm nervous about are maybe more existential about your space. And, it's very hard to raise with that kind of timeline and pressure. And conversely, the same funds who may pass in a 4-week sprint, if they're getting to know you over 6 months, and by the way, they're still taking that call 6 months later, they probably see something they're excited about, right? And they've also gotten to know the most important person that they're investing, or most important thing they're investing in, which is the founder, and the founder's ability to navigate future risk and threats from AI and everything else. So that is, again, it's maybe an unpopular view, because there are a lot of founders who are like, look, when I'm business building, I'm business building. When I'm fundraising, I'm fundraising. And power to them, right? Do what's right for you. But we are seeing the benefits for founders who are able to do some of that more like long-term relationship building with an eye towards, look, I probably will need to know my investor for substantially longer than I did before, to run a successful fundraise process.
Yeah, that's a really important point. And maybe, founders, myself included, should not really think about this as fundraising
Right.
necessarily. It's relationship building. It's friends, like having friends that intelligent friends that actually you can talk to about business.
Yep.
And the more deep conversations or friendships we have, the better. Like one of the things that I've noticed is that like the number of our connections is constantly increasing,
Yeah.
but the quality of the conversations is decreasing. And that's something that I'm like always, especially like on LinkedIn, is like, we have all these numbers. The numbers just keep going up, right? But how many real relationships,
Yep.
really beneficial two-way? It's not just one side. So I think that's definitely, I agree with that as far as like, really building a relationship with and getting to know people.
Yeah, 100%. And look, it may not be the same people for every phase of your business. And it may be that 5 people is the right number at some point. It may be that 20 people is the right number at some point. But to your point, it's probably not 50 people, right? In fact, I think the other thing, this is always true too, but especially in this environment, right? I think founders have a temptation to ask for advice from everybody, because it's like, hey, what's going on in the market? What are you seeing? What valuations, what multiples, like what metrics matter? And that's great, right? That's super important. At the same time, if you're asking that question to 50 people, you're going to get roughly 49 different answers, right? Even if they're only slightly different, and many of them will not be slightly different. Many of them will be very different. And the one of the founder's hardest jobs in general is to know what advice to take and know when to trust their gut. But it does become harder in this environment too, because there are more diverging views and perceptions of what's going on in the market. And I think it's human nature to gather a bunch of data points, but then being able to sift through those and make sense of those, and not get confused by those, is just more important than ever. And to your point, if you don't have a few high quality relationships and instead a bunch of, very spray and pray, light touch relationships, the risk of confusion is much higher.
So what's the best way for founders, especially the ones that are not like, well known,
Yeah.
to stand out in the sea of other founders and they're all trying? What's the best way? Is it content? Is it like trying to sound smart and have smart comments, or is it like caring, being proactive, building, showing that you are actually building? What are the things that actually stand out for you to say, okay, you know what, I want to stay in touch with this founder?
Um, Great question. I will try to give an answer that I think is more timely than the generic answer. Because this has always maybe been true for me, but I think it's especially true now. Um, I think it's the do more with less attitude, right? And that's what I was talking about earlier when it comes to sort of the risks versus benefits of AI tools. And I think everything else that mattered before still does, right? I mean, visionary founders who have kind of a passion for the space they're building in, have a unique insider understanding around it. All of those things, I think are table stakes. But the ability is in this environment to do more with less and to demonstrate that in the results or in what you've built or in how what you've built is functioning goes a very long way with an investor, because then I'm like, hey, look, as I said earlier, it's like I'm taking a bunch of risk, but I know that you're not just getting from A to B with my capital, you're getting from A through F, and then we'll figure out the rest of the stuff, but at least you'll be at F. And I think what goes along with that is, a founder who knows sort of what they're looking for in an investor and is focused on kind of the journey versus just focused on optimizing for valuation, right? And I think
Yeah.
really, again, more than ever before, it's like if you're focused on valuation right now, you may be focused on the wrong thing, which eventually, actually works against you. The founders who are doing more with less right now, maybe taking, the slightly lower valuation, but partnering with the right investor, they are, likely to own more of their company when it really matters than the other way around. So I think, it's not talking smart. It's not content for the sake of content. I mean, it's become way too easy to generate content. And so I think I think that plays a role in making sure that you are at par with everybody else from like an SEO standpoint. And I think it does relate to doing, more with less. Just in terms of like, if you're a consumer facing business or you're selling to businesses that just your marketing stack is kind of AI powered. But as a founder, I think what just really goes a long way is demonstrating, what you can achieve with very little, how scrappy you can be, alongside, of course, being visionary and of course knowing, what you need to go build the big business you're going to build, but de-risking as much as you can upfront. And I talked to a lot of founders about like, what's the core engine? Like, what's the flywheel that's just working? And then, look, that's not maybe the like 10x, 100x technology business I'm excited about. That 100x technology business is out here, but you've got something sort of like working in the background that you can build upon versus like, I'm going to go, straight to the 100x thing. Not every business, is conducive to that, but I would say certainly for like a lot of e-commerce businesses, retail tech businesses, there are tools out there that can kind of help you generate that. Like, what is the platform that we're starting with? How does that start to just kind of function on its own? And then you have the mental bandwidth and the financial bandwidth to go build sort of the bigger thing.
Okay. Yeah, so I think definitely what you started with is really understanding the current times and the dynamic of what's happening. Like what founders did 2 years ago, 3 years ago, maybe even a year ago
Yeah.
for raising money is different than 2025. And we are in a completely different world. And resetting the expectations and communicating that effectively with potential investors, I think goes a long way to just say, you know what, I don't have to try to explain to this founder this is not the same as last year. So I think that's probably something that really goes a long way for me is like people that I talk to that are still like living in the past.
Yeah, and again, I think we understand that like founders' time is their most precious commodity or scarcity. And it's not sitting here and saying like you have to work that much harder to fundraise. I think it's sitting here and saying just be a little smarter in planning it, right? Like plan in advance, qualify your leads, right? Don't spend time with investors. Again, like I've always been amazed that founders like to do these processes where they have a list of 100 and then they do 50 meetings. It's like you may not need to do all that if you plan a little bit ahead and really focus on the investors who are most likely to do this. And maybe because they've known you for a while, maybe because you've spent time with them before it really mattered. And because you've been able to demonstrate that you can do more with less.
Yeah, I think again to just close this out, just the
Yeah.
more we talk, the importance of knowing who would be the ideal uh, investors in your company and just focusing on building those relationships is probably the best thing a founder can do.
100%. And I think, it's also true that investors, and this is, I'm generalizing a bit, but I think investors have also, part of their reaction to the shifts in the market has been like, what do I know and what do I not know, right? Or what is my risk appetite and what's not my risk appetite? And I think part of, the noise in the bubble of a few years ago was everyone started to do a little bit of everything. I was a seed investor, I started doing a little Series A. I was a Series A investor, I started doing seed. I was a consumer investor, I started doing deep tech. And I was a deep tech investor, and I started doing enterprise SaaS. And it just, again, just to get into deals, just to deploy capital, that was the mindset. And everyone is like, the pendulum has swung in the other direction. So I think you very quickly, now kind of where an investor's appetite is, and you can use that to your advantage and not waste time beyond that. And also not take that as a negative signal, right? Because you are
Yeah,
not, this is a 10 plus year relationship. If everybody was a fit for you, I mean, that probably says something about your business. Like
you
everyone is not
probably
a
have
fit.
a product that's not focused enough. So
Exactly, exactly,
yeah.
exactly.
Uh, let's talk about something else that's I think really important before we get into some like specific technologies, maybe. The concept of, you also mentioned defensibility and what the Oracle of Omaha used to calls the moat.
Yep.
What is the moat today in 2025 and looking ahead at least maybe 2 years because it's constantly changing? What do you think is the moat that people can actually really build and would you believe in?
So we spend most of our time looking at, the application layer, right? Whether it's B2B or B2C tech, we don't spend as much time in kind of infrastructure or sort of middleware technologies, certainly in AI, but more broadly. So I'll caveat what I'm about to say with, we focus on application layer, on usage layer, and that shapes my definition of moat. Um, and it really is, I think, two things right now. One is a proprietary understanding of something, and usually it is either a data set or it's a user experience. And so when we look at, whether it's AI powered or not technologies, it's look, you might have the best algorithm, that's great, but it only matters to me if you have the best user experience as a result of that. It only matters to me if you have proprietary data that's training that algorithm that nobody else has and unlikely to have in the future, or by the time they have it, you will have progressed in your understanding of this specific user so far that we're not as worried about that threat. So again, it's either proprietary data or proprietary understanding of a user and a user's experience, not the underlying algorithm or the models they've chosen to use or something else kind of in that, the technical functionality. And then two is customer acquisition. I mean, that still continues to be both for B2B and B2C companies. Again, we look a lot at the consumer world. And so, customer acquisition is still kind of one of the most expensive, challenging, and frankly, just like volatile things that founders go through, right? If I look at so many companies in our portfolio and you look at performance, curves over time, like the number one thing that correlates with how performance changed is how the customer acquisition engine changed, right? It became more expensive to acquire customers because something happened to conversion, or we've shifted to using an agency and we were doing it in-house, or we were using an agency, we brought it in-house, and like something went wrong with the acquisition and conversion engine. So, I think that like from a defensibility standpoint, it's the businesses that have, regardless of the tech stack and regardless of, what vertical the business plays in, if they've figured out a way to hack that volatility and say, look, we've got something, whether it's an organic engine or product-led growth or a unique audience that they speak to really get around just being at the mercy of performance marketing and all the volatility in that space, that's a huge moat, right? Because I mean, it's both like a unique advantage and allows you to grow a user base, much more quickly without just hemorrhaging investor cash. And again, then it takes a lot for somebody to catch up once you've been able to do that.
So is the first mover advantage actually a moat?
Uh, Not always. And I think in both of these cases, it's not first mover, right? It's the first one is sort of like a unique understanding of a problem area or of a user, and then the unique sort of data that supports that user's experience. And the second is a customer acquisition engine, and both of those, if done properly, and done early on, of course you can scale well enough ahead of any future competitor, but you can also leapfrog a first mover, and that first mover, is no longer has that advantage. So I think first mover advantage is often maybe misused as a way to represent a moat when really, of course, network effects still matter, and all of the things that used to be sort of the pillars of first mover advantage still matter. But I think technology and just the way, the ecosystem has shaken out has proven that there are also ways to leapfrog some of that.
So I would say, probably from my own experience, first mover advantage really works if you're Sam Altman. Otherwise, don't count on it. And Sam works very hard. And he's worked for many years to build the relationships and what he has. He didn't
Yep,
just like wake up one day and,
100%.
so um, yeah, I mean, it seems like, so is technology really not a moat anymore?
Oh,
Again, I
I
know we're
think
talking about front, not really
right.
hard tech.
Yeah.
Yeah.
Yeah, I guess I would put it a little bit differently, which is it's how you leverage the technology is the moat. The technology itself, it really depends, right? Because there are so many spaces where the technology itself has become a bit of a commodity or is changing so rapidly, where what's best today may not be best tomorrow, or what's best tomorrow everybody has access to. So it's how I use it, and how I apply it to a user experience or a buyer experience. That really matters. And I think good examples of that are actually, and you might argue this is where first mover advantage worked, but there are still some spaces where we're seeing legacy players not be unseated fast enough. And this is a terrible example, but Facebook Marketplace, for example, still has millions and millions of transactions every day on Facebook Marketplace, which if you've ever used it, you know how clunky an experience it is, right? I mean, it's basically not tech enabled. I mean, you're messaging back and forth with somebody, you're bidding on 10 different things, the response times are slow. But just because of Facebook's entrenchment, um, and we know they weren't really a first mover in social networking, but they obviously have now entrenchment, increasingly with an aging audience, but whatever it is. But we look at newer marketplaces, peer to peer and otherwise, that have much more seamless experiences, but it's going to take them a real hack to figure out how to compete on volume with Facebook Marketplace, right?
Mhm.
And so clearly, technology is not a mo. I mean, it's not Facebook's, at least marketplace technology, like buying and selling technology, has not evolved in 10, 15 years. Um, but it'll be difficult to sort of capture all that volume overnight just on technology alone. The go to market, the network effects, the scaling strategy, all of those things will have to play a big role.
Yeah, the Facebook Marketplace is a very interesting example because I've been thinking a lot myself about really the whole concept of you have a whole bunch of stuff in your home that you don't need anymore. And
Yep.
where do you sell them so that you're not just like throwing them away? And of course, there is eBay, and then there's Facebook, and there are other like uh, marketplaces. And like, what is the next generation of all of these peer-to-peer probably marketplaces is a very interesting question for me. I personally, I've started using Nextdoor,
Mhm.
Next door is doing good, but they're really building the same UI. They're
Yeah.
just copying the Facebook Marketplace UI, and it's the same flow catalog, scrolling up and down over and over again.
It's a good I totally agree with you first of all, right? I've never been a very active peer-to-peer seller, but I mean I now have three little kids and like the amount of like baby stuff I have that I just want to get rid of, but I want to do so in a thoughtful way. Just the clutter in the house, right? And it's more than ever before. I would love to very quickly be selling things and doing so in a way that doesn't feel like it's a huge detriment to the environment. Um, but those experiences are still quite clunky. Now, that said, I mean, we've talked to a bunch of companies. I would love to make an investment in this space. The technology is also, not that, it's not a lot of proprietary technology in that space either, right? I think very quickly, of course, there are good, great, and best image recognition, models out there, and the same for video, and the same for voice to image or voice to text and all of that. Um, but the hardest part about building, the much better Nextdoor or Facebook Marketplace or eBay is going to be in the network effects and scaling. Because who cares how easy it is for me to list an item or price an item if I can't efficiently sell it and efficiently get it to the person who's buying it. And so buyer and seller density and like efficiency of matching and all of that is really driven obviously by, the number of people using the platform. So all that is to say, I agree with you. I think this is a space we will see innovation, and we will see, I'm sure eBay at the very least, maybe also Facebook will improve, the technical functionality of what they're able to offer and how AI powers their experiences. Um, but hopefully somebody else comes around and does a much better job of all of it. But the hard part will not be the technology. The hard part will be now how do you amass the scale very quickly that some of those other platforms have.
What do you think about the concept of guerrilla marketing?
It's a great question. It's very timely. We are announcing an investment in a couple weeks where, our experience suggests that it's in a space and with a target user that, decade over decade has shown that I won't say guerrilla marketing, but like maybe an expanded definition of guerrilla marketing, events-based marketing, kind of word of mouth strategies, clever, kitschy, getting in front of people, generating stories, earned media, where all of that has proven to be, one of the most successful ways to grow. And human nature doesn't change. Technology changes and the customer acquisition landscape changes, but human nature doesn't change. And I think a lot of those strategies will continue to appeal to people in certain spaces for certain products. I think guerrilla marketing will continue to be a very powerful growth strategy. It's obviously very hard to do well, but it does appeal to, I think, something fundamental in all of us. When we're like, hey, remember that, random sign I saw at this event, and they told an interesting story, and the people there were really interesting, and that's just a much better story than like I saw an Instagram ad for something.
Yeah, that's the challenge right now is like really there's so many people saying the same things, maybe even in great, beautiful graphics and video and everything, but it's the same thing and it doesn't stand out. And I think this is something that we're doing ourselves in my company is like really trying to go local
Yeah.
and start to make connections with people. And that is something that I want to also ask you about is the role of human beings in this whole ecosystem and cycle of technology and apps and AI and everything. It's like it seems to me, again, like I love seeing people like innovate, but I see one new AI shopping agent every week, and they're all doing the same, and
Yep.
they're all seem to be trying to get rid of human beings on the selling side,
Yep.
which is interesting. And I'm really interested to hear your thoughts about the role of humans on the selling side.
Um, Interestingly, I just looked at a company that is doing AI for in-person marketing. So the idea is, how do I scale myself? If I'm, most likely a B2B seller of some technology or product, how do I take my everyday experiences and like AI power them to make them selling experiences? So it is, it's maybe the inverse of what you're talking about, which is like finally AI has come full circle, not to replace the human, but ideally to empower the human. Um, I like to think that that's the direction a lot of this will ultimately go. There will be spaces where just the labor cost does not support selling, human powered selling. And I think especially, given some of the stuff going on in the international economy, um, those will be really important and powerful tools for retail to support um, basically, businesses that will either have to gouge customers or go out of business if they have to continue to bear labor costs. Um, at the on the other end, I think there are experiences that no matter what, the human seller is really a part of the product, right? It's like, why do I buy this thing? Even B2B technologies, but certainly luxury goods. Why am I buying this? I'm not buying just the best product. I'm buying it because the onboarding experience, the sales experience looked a certain way, felt a certain way, felt human, felt authentic. And I think that there will absolutely be a space for that, right? And I think in those spaces, it's a question of like, how can AI support that human connection rather than replace it? And like I said, we're seeing technologies that already understand that. I think the only other thing to point out there is the new generation has a healthy amount of skepticism around not just AI, but around anything that feels inauthentic and inhuman, and has a very different relationship to technology than like I had, for example, growing up, where I got my first phone, I was 15, and it was a flip phone, or not even, it was like a small Nokia, right? And technology for me has never felt threatening. It has felt like this huge opportunity. But if you were born in the last 20 years, technology has been kind of like table stake and just gotten, slightly scarier each year in terms of what it can do and how it changes authentic human experiences. So I think the new generation will also um, push retailers, brands, and tech companies to be kind of really thoughtful in the replacement versus empowerment decision tree.
I have this crazy idea that humans are the moat in the future. How can companies that are only building these AI tools, which might look great, how are they going to survive if they have no connection to the real world?
Yeah, again, I can't claim to know the future, even though maybe that's supposed to be my job. But what I do think is important is this idea of like empowerment versus replacement. By replacing certain things, and I think this is true for parts of retail, right? That especially those that are facing a lot of pressure right now. We have some portfolio companies, both in the retail tech world, selling to brands, and some consumer brands that are experiencing the pressure of tariffs, for example. What is undeniable to them is at the end of the day, like my customer comes first, second, and third, and I need to think about their needs, and I can't just pass through this pricing to them, and I need to be, thoughtful about the authenticity of my brand and the story, that goes with it, and the mission that we set out here, and I can't just completely, you know, um, sort of 180 from that because I now have all this cost pressure. And so for them, it's sort of like, what are the tools that I can use to empower my brand? And yes, some of that might be replacing humans, right? Because I can't sustain the workforce that I had to, the ability to sustain before. But it then frees up some humans to think even more creatively about appealing to our mission. Um, so again, I think it's a mix. I totally agree with you. There are some businesses that just may not find that balance. But my hope is that many will, which is thinking about, when you are when you're replacing something, you're also freeing up capacity for something else. And what can we do with that capacity to allow for like a 1+1 is 3 outcome.
One final note on that topic of how do we actually handle the changes that are out of our control, or at least they
Yep.
seem to be out of our control. Now, luckily, we live in a democratic society here.
Yep.
And what I think is that if the industry completely removes the impact to consumers from the tariffs, consumers may not really understand what is happening. And I think maybe it is better to translate some of that impact as much as possible so people actually see the
Right.
result of what's happening and make change.
There's the reality, which is for some of these brands, and we're seeing this with brands in our portfolio, no matter how transparent they are, and in trying to communicate it to customers, maybe customers get it, but then sales are down, right? And so it's the balancing act of, we want to be transparent, we want to, we want to keep running this business, but we also need to balance like shielding them from the impact and then the impact on our business as a whole. I agree that this situation is probably not sustainable. And so whatever needs to happen for consumers, businesses, and stakeholders in the ecosystem to kind of weather the storm until we get back to a place of equilibrium. I just hope that in the process, great businesses, don't fall apart.
Thank you so much, Smriti. Fascinating conversation. How do people get a hold of you if they want to pitch or just connect?
Yeah, sure. You shoot me an email, smriti@corazon.com. I'm, happy to chat, especially if you're building something super exciting in spaces that we invest. And we'd love to, we love meeting founders, and encourage founders everywhere with an idea and a passion and an interest in building a business. It's not a scary time if you approach it with the right mindset and you're prepared and you're strategic about it. It actually could be one of the most exciting times to go build a great business.
Thank you so much again.